Hey guys, and welcome back to another pre-recorded lecture before class time. Um, what I want to do is kind of just run through real quickly the PowerPoints of Chapter 15, which has to do with raising capital, and kind of point out some of the important things that you guys need to, kind of know and should be able to um, at least remember before class time come Monday. I know school was closed today. Today's Thursday, and I believe it was closed yesterday as well. So hopefully you guys are keeping warm out there in the cold weather. Uh, but Chapter 15 really deals with raising capital. So hopefully you've had an opportunity to read the chapter. I know I was a little late on getting that study guide up, and again, I do apologize for that. Um, but hopefully you've read the chapter, and if you notice that the chapter really talks a lot about, or at least in the beginning, talks about venture capital markets, right? It talks about how these angel investors, as they call them, provide financing to new high risk companies, right? And if you can think of any company that you can think of, Uber, Google, um, Lyft. I'm running out of names to think of, but I'm sure all of those started off with venture capital. So we're going to talk a little bit about that in the video, as well as on Monday in class. We'll get into a little bit more detail about venture capital markets. You should be able to explain how IPOs are offered, initial public offerings, right? As well as talk about the investment banks and the underwriters in that process. So you should, from the video, you should have, and reading the chapter, obviously, you're going to get a general idea. And again, we're going to talk about this in a little more detail, or a lot more detail actually, when we get the class on Monday. You should be able to describe IPOs and as well as the costs that are incurred to actually go public. Okay, we'll discuss a little bit of those tonight or in the video, and then we'll definitely talk about that on Monday. And the same thing with rights. How are rights issued, right? Um, what happens to existing shareholders, right? How do we value these rights? So if you can just kind of understand what rights are, how they're issued, um, how to value them, as far as what's the calculation. We'll get into the nuts and the bolts and the actual calculating class on Monday. But again, if you have an idea, general idea, you'll be fine. Okay, so venture capital, right? Um, there's venture capital markets, and there's individuals. I believe if any of you guys are on Instagram and follow Gary V, right? Um, Shark Tank. If you've ever seen the TV show Shark Tank on, I think it's on MSNBC, those are venture capitalists, right? There's people out there that have a boatload of money. They're interested in helping people and getting people, started in a business, but they don't do it for free, right? Um, they want something out of it, and usually that something is equity in that new firm. Okay, and again, we'll talk into a lot more detail about this in class, and we'll kind of work on an exercise about venture capital deals. Okay. How to choose a venture capitalist. You should know, what to look for when picking a venture capitalist. Keep in mind the slides and whatnot kind of make it seem like, hey, it's real simple. You just go knock on the door and say, hey, give me money. Well, it really doesn't work that way, right? Venture capitalists as well as venture capital firms are very selective, right? They have a ton of proposals, and they probably only select maybe one or two, right? Um, the book talks a lot about, or a little bit actually, that it's an individual market in a sense of making contacts and knowing certain people. That's kind of how you get connected to venture capital. So who's able to choose the venture capitalist that they want to work with, right? Well, normally if there's a successful entrepreneur who has a track record of starting companies and raising money or making money and turning those companies public, people like that normally have the option of choosing which venture capitalist they want to go with. Okay, um, pay attention to selling securities. The study guide offers or asks a lot of questions regarding um, selling securities to the public, or those IPOs, and all the definitions that go along with an IPO. Things like prospectuses, the red herring, and please don't write down red fish. It's not a red fish. Um, but make sure you have a good understanding of what those things are. When we get into class, we're going to talk about Regulation A in a little more detail. So you should know what Regulation A is, right? This is kind of interesting. Crowdfunding and crowdfunding, right? Or initial coin offering. Kind of interesting, allowing companies to kind of raise small amounts of company from a lot of people, right? And we can do that, the GoFundMe pages. There's one page, I can't remember what the name of it is off the top of my head, but I see it on social media a lot. People that are starting, want to produce a product. I'm a nerd, so I'm into like stationery and pens and stuff like that. And I see, occasionally I'll see someone that has maybe a prototype of a fountain pen or a new satchel or briefcase or something, and they'll put that out there kind of like as a GoFundMe kind of a thing, so you can donate money to get that bring that product to market. So kind of interesting. We will talk about the methods of issuing new securities when we get to class. But keep in mind, we're looking at the traditional negotiating cash offers, right? That's one method, okay? And there's a number of types within that. We can do the firm commitment cash offer. We can do the best efforts cash offer, and we can do the Dutch auction cash offer, okay? And again, the difference between those three really have to do with, is it an auction? Is it an agreement? What do the underwriters do? Do they keep the shares that they that they don't sell off? So again, being able to differentiate between the methods of issuing stock and the types the types of methods, or the different types of the methods. We'll definitely talk about that more in class. So I would definitely pay attention to this slide right here. Make sure again, what a firm commitment cash offer is, right? It's where the company negotiates an agreement with the investment banker. The investment banker is going to be the underwriter. So they're going to take care of everything in a sense of they're going to underwrite the offer. They're going to distribute the shares of or the IPO, right? The new shares, okay? And basically what happens is usually the investment banks will purchase the IPOs, right? And then they sell those at the higher price, okay? That's one way of doing it. Another way is the best efforts cash offer, right? This is where the company has the investment bank, right? The investment bank or the investment bank, excuse me, they do the best that they can, right? They sell as many of the new shares that they can possibly share, right? At some previous agreed upon price, right? There's no guarantee with the best efforts cash offering, however, how much cash will be raised, okay? Excuse me. Then there's the Dutch auction cash offer. Again, what happens is company has an investment banker, right? They auction shares off to determine that highest offer price for a given number of shares, Okay. There's the privileged subscription, right? We have the direct rights offer or we have the standby rights offer. Okay. When we're looking at a direct rights offer, the company offers new stock directly to its existing shareholders. So we're not going public in the sense of we're opening up the IPO to everybody. No, no, no. We want to raise money, but we are going to go directly to our current shareholders and say, hey, you want to buy more shares? The standby rights offer, it's kind of like the direct right offer. However, this actually contains a privilege, right, or a subscription arrangement with existing shareholders. So any net proceeds are guaranteed by the underwriters. Then we get into the non-traditional cash offer. And again, there's two types of non-traditional cash offers. There's the shelf cash offer and the competitive firm cash offer. So you should know the difference between those two. And then finally, there's the private method, and this deals with, or the only type of private method is direct placement. Okay. You should definitely know what the underwriters are, right? What do they do? What services do they provide? Okay. Basically, when it comes to the underwriters, and again, these are investment bankers, okay? They formulate methods used to issue securities. So they basically facilitate issuing the securities, okay? They price the security, they sell the security, and they also act as a price stabilization by lead underwriter. What's that mean? Well, the price stabilization is an important component of the lead underwriter's job. Okay, and usually what happens is a group of banks get together, or investment banks, and they say, okay, we're gonna underwrite this. But usually there's one that kind of steps up and takes the lead job, right? And we're gonna look at we get to class. We're gonna look at an article which I'll post here too once I'm done with this, dealing with stabilization activities of underwriters. Okay, the syndicate, again, that's just a group of investment bankers. Remember, I said there's a group of investment bankers that get together and underwrite the issue. Well, that's the syndicate. Okay. And then there's always a spread, right? Now, the typical spread for an IPO between, maybe 20 and 80 million is about 7%. Okay. So, we'll talk a little bit more about that in class as well. But just keep in mind, you should know, again, have an idea of what underwriters are and what they do. Okay. And again, we're going to talk a little bit more about firm commitment underwriting. We'll talk about best effort underwriting, Dutch auction underwriting. I just quickly went over some of those. But we'll get into more detail when we get into class. Now, green shoes and lockups, right? The study guide asks, what is this green shoe provision, right? But what are lockup agreements? That's also important. So what a lockup agreement is a restriction on insiders, okay? What does this do? Well, the restriction is to prevent them from selling their shares of an IPO for a specified period of time, okay? So basically the lockup agreement says, you know what? Okay, you're an insider, right? Maybe an investment bank, whatnot. And what we say is, you know what? You're locked up for about 180 days, meaning you have to hold on to those shares for 180 days. Okay, you can't sell them right away because that'll affect the price, right? If the IPO comes out and an investment bank has these shares, they're trading and whatnot, and let's just say the investment firm says, we want out, right? Well, if they dump all these shares on a stock, what's going to happen? Possibly the price could drop, right? If they're selling off. And again, that stock price does tend to drop when that lockup period expires. And again, the market anticipates these additional shares hitting the streets, okay? And that's the reason why that stock price may drop, or tends to drop, let's put it that way, after the lockup period. Okay. Um, we'll get into calculating IPO underpricing when we get to class, but we'll calculate those when we get to class, actually, how to determine if an IPO is underpriced. Right now, you should know what it is, right? Or come Monday, hopefully you know what it is, okay? Let's see, what else is important that you really need to focus on. Rights offering. You need to know what rights offerings are, right? What are the basic concepts? What rights are we given to shareholders, right? Well, we're going to specify the number of shares that can be purchased. We're going to specify the purchase price, and we're going to specify the time frame of these rights. Okay, so what are rights? Well, these are these are rights, excuse me, that we already, or that we issue to common stockholders, right? Meaning existing common stock shareholders. Okay, we just don't go out to the public and offer this to people that don't have our shares. No, these are existing shareholders, and we say, hey, we have a rights offering, right? And basically, what this does is or what it prevents actually is dilution. Okay, meaning current shareholders can keep their proportion or their power of shares. Okay, think about it. If we issue shares, okay, and we say, you know what, existing stockholders, we're not going to give you the rights, right? We don't care about you. We just need money, so we're going to sell them to other people. Well, those current shareholders, their rights are going to be diluted, right? Their earnings are going to be diluted because there's more of the pie. So what these rights really do is allow the existing shareholders to maintain their slice of the pie, or their proportion of the pie. Okay. Don't worry, we'll get into the value of a right in class. We'll work on some of that. We'll talk a little bit more about dilution. You should know the difference between private issue bonds or bonds and private issue bonds. You should know what the difference is. We'll talk a little bit more about that in class as well. But these are just terms of, or types of long-term debt. Okay. Again, bonds, these are public issue of long-term debt. Private issues are more, we have, term loans, private placements. Again, when we're dealing with private issues, number one, they're usually shorter in maturity. Okay, meaning the private loans, term loans go 1 to 5 years. Think of private loans how we get loans. And when I say we, I mean like, you and I, the consumers. Okay, right? We want to buy a car. What do? Well, fortunately, we can't shell out cash for it, so we go through a bank, right? And we say the bank gives us a loan, and usually that's a term loan. Right? It's good for 5 years. We have to, repay them during the life of the loan, usually at the end of the term, say 5 years, loan's gone, right? So that's what term loans are. And businesses do the same thing, right? Businesses loan or borrow, I guess you could say, from commercial banks, from insurance companies, maybe from other businesses. Okay, that's a possibility too. When we're talking about these private placements and these term loans or these private issues, these are a lot easier to renegotiate, than public issues, right? Meaning the bonds, because these bonds are usually 20, 30, 25, 15, 10, whatever years, so they're long term, right? A ton of people have our bonds. So it's pretty hard to negotiate or renegotiate rates or anything like that with the bonds, okay? That's pretty much it as far as chapter 15. Again, I just wanted to give you a kind of like a heads up. point out some things that are going to be important that you should know when you come into class. Now, I have not an assignment, not really an assignment, so bonus points, okay? And we'll say these will be good for 3 bonus points. What I want you to do is I want you to pick up one of the topics in here, whether it be IPOs, green shoes, underwriting, whatever, any of these methods of issuing new securities. And I want you to find an article on that, okay? Now, I know some of you are very, very savvy. And if you look through the PowerPoints, they say, hey, for more information, look at this article that was in a finance journal. Do not pick those articles, all right? Because I already got them, and we're going to talk about them in class, or read over them and talk about them in class. So please don't pick those articles. Pick other articles surrounded by these finance topics that we're talking about tonight. Venture cap. Maybe you find an article on venture capitalists. Maybe you find an article on selling, IPOs, selling to the public. Maybe you find an article on crowdfunding. Okay, so bring these to class. Read them, obviously. Bring them to class, and then we'll discuss the articles that you have. Okay, so again, these are for bonus points. So you're watching the video. You should get credit for it. Please don't share this with others that don't watch the videos, because this is your reward for doing what you're supposed to be doing. Okay. So again, if you have any questions, please feel free and shoot me a text. Totally not a problem. Again, I do apologize getting this up a little later than I'd like to, but the weather kind of threw me off. So again, if you have any questions, I'm available. Just let me know. Thank you so much for tuning in, and we'll see you guys on Monday.